All right, everyone, we're back. We got a real fun one for you guys today. We've talked about covered calls in the past, not only in its own lesson about covered calls, when to do them, what delta call that we're going to sell against our 100 shares of stock, and how we're going to roll it, et cetera, et cetera. But we also talked about it, how it can be one of our nice shortcut trades where we're able to have much better returns than the overall S&P 500 doing a simple strategy just like a covered call. Again, covered call is a really cool thing because you are able to execute a covered call in any type of account, right? So you don't just need a margin account to do so, right? Which makes it awesome. And again, it's a very profitable strategy. Covered calls are bullish strategies, and obviously we've been in a very big bull market over the last 9 years straight without really looking back. So bullish strategies in that kind of a market will obviously do really well. But one of the downsides of covered calls is they're capital intensive, right? So if we were to go ahead and we were to execute a covered call right now in SPY, if we were to execute a covered call in SPY right now, the price of SPY is 246.58. If we wanted to buy 100 shares in a normal account, it would cost us about $24,658 to do so. And then if we had a margin account, it would still cost us $12,000 to do so, right? So a covered call, while a profitable strategy, there's absolutely no denying that it's a very profitable strategy, it is kind of capital intensive. Now I'm going to introduce you to an options only covered call. So maybe there's a way to get the same type of profitability and directional bias to the upside in this bullish strategy by only using options. Remember, options, guys, options are just synthetic versions of stock, right? So there's likely a way to do that. Let's find out. So again, an options only cover call is synthetic cover call using options, right? So we're not purchasing stock, right? This is obviously a bullish strategy that benefits from an increase in prices as well as an increase of implied volatility, and we'll see why here in a second, right? So again, rather than having to buy 100 shares of stock in order to be able to sell a call against that to cover your stock position, right? We can go ahead and maybe buy something called a deep in the money option. So if you guys remember, an in the money option, specifically an in the money call, is a call that is in the money and the price of the stock is already above the strike price of the call, making it in the money. Deep in the money are those that are very much in the money, right? And similar to the way we sell, let's say, a 30 delta call, that's the best strategy for a cover call. We can do the same very easily for a options only cover call, right? So we did something very, very similar as we do in all of our other strategies. This one took me for freaking ever to do, but it's well worth it when we look at the actual results and how effective these results are. So from 2003 to present, so again, that's 14 and a half plus years of everyday data, depending on when you're actually watching this lesson, right? So we did a couple things. The first thing we did was we executed a straight up cover call. So we bought 100 shares of SPY every single day, and against them, we sold the 30 delta call in the monthly expiration cycle closest to 50 days from that point. And what we do is we let that trade expire on its own, right? So that's pretty straightforward. We're going to buy 100 shares. We're going to go to the monthly expiration cycle closest to 50 days. And we're going to go to the 30 delta call, and we're going to sell it against it. So actually a way you can do that is analyze by covered stock, right? So that's what we did. So we bought 100 shares, and we sold the call closest to 50 days from expiring at the 30 delta against it, right? So that would be one part of the trade. The second part of the trade was we wanted to do our options only covered call, right? So what we did was we went ahead and we bought the 30 delta call in the monthly expiration cycle closest to 100 days from expiring, right? So let's go ahead and take a look at how we did that, right? So the monthly expiration cycle right now, closest to 100 days from expiring, is this December expiration, right? Right? And remember, it's the 80 delta call. So in the money. Anything that's higher than a 50 delta is already in the money, which means the price of the stock is over the strike price, right? So we went ahead and we went and bought the 80 delta call right there. Bang. It's already there for us, right? We went ahead and bought that. That gives us the equivalent of 80 shares of stock. So it doesn't give you the exact same equivalent as the 100 shares of stock. However, it gives you about 80% of the same price movement. And again, as prices move up, you will have more and more synthetic shares here because the delta is going to go up, right? So that's the first half. Then what we did was we went ahead and did the same thing as the covered call, but this time in the options only covered call. So we sold the 30 delta call in the monthly expiration cycle closest to 50 days, right? So we did that against our long call here, right? Our long 80 delta call. So where is that? It's here, bang, 30 delta call, and we're going to go ahead and sell it against. Great. That's called a diagonal. Don't worry about it, right? This is an options only covered call for us, right? So you can see there's obviously a pretty big difference in price here off the bat. there's a pretty big difference here in price off the bat, but we'll go ahead and take a look at that here in a second. Okay, so then there was no management on these trades whatsoever. No management on these trades, and there was no note of volatility. So we just did it every day, held them to expiration, rain or shine. Didn't really matter what happened here. Let's check out the results. So how do we do? Well, for starters, we can see that the cover call does work. The cover call is, in fact, a profitable strategy for us. And it's actually a pretty nice strategy. Again, making 0.75% on your money in a 50-day period across the board is a fantastic result. It's an absolute fantastic result. Again, being right 68% of the time. Again, buying stock outright, guys, buying stock outright is a 50% chance of making money. However, selling the call against it, right, selling that 30 delta call against our long 100 shares of stock to complete an actual cover call gives us an 18% extra in terms of our win percentage, right? Now, we average about $112 per trade. Awesome. And our average margin requirement over the length of that study, which again, the last 14 and a half years, depending on when you're watching this video, was about $15,000 for 100 shares, right? So again, the total average return on capital per trade, 0.75% for a 50-day period, which by the way, is phenomenal returns. However, when we look at the other side, we see a little bit less of a win percentage, 65% compared to 68, a little bit less in a P&L per trade, about 82.99 as opposed to 112.03. However, now it gets interesting because the average margin requirement is about a tenth of what it takes to buy 100 shares of stock. All right, so the fact that we were right a little bit less, the fact that we made a little bit less money, however, the capital required to execute that trade was about a tenth of what it is now, which is pretty remarkable. That's why the average return on capital for the options only covered call is about 5% per trade as compared to less than 1%, right? So we're looking at a 6x improvement in return on capital per trade when we're using the options only covered call. That's pretty remarkable. Again, remember, when stocks are down, covered calls are excellent strategies, right? We're playing a reversion to the mean when we're looking to execute a covered call, right? And we're reducing our cost basis in both scenarios, right? We're reducing our cost basis in both scenarios by selling the call against it, right? So if we look at the normal covered call, the price of stock right now is $146.58. However, we're able to sell the 30 delta call to reduce our cost basis to about $1 less than what it is now. And if you remember, going back to the price of that 80 delta call that we purchased, right? That's about 18 bucks and 70 something cents. However, if we're able to sell that $1 call against it, we're reducing our cost basis here as well, right? So again, we're reducing our cost basis by selling those calls. It's a bullish strategy. When stocks are down, this is definitely something we can do. However, it's more advantageous for us not to buy that 100 shares of stock. Right? It's not advantageous for us. It's advantageous for us to buy that 80 delta call because we get a much better return on capital. We're able to execute this strategy, get on average over the last 14 and a half plus years, a 5% return on our money, doing it every single day, not managing it with our winners, not worrying about implied volatility, and we only have to give up about $1,600 on average in terms of margin requirement to exit those trades. So when stocks are down and you're thinking about a bullish strategy like a cover call, I highly recommend at this point an options only cover call. I'll see you on the next video.